Welcome to Integrity365 Financial Insights Podcast. I'm Nicola Glass, and today I'm joined by my colleague Esther and Clemmey. Today we're going to talk about understanding your retirement options. So this is going to cover withdrawal methods, investing styles, various sort of areas and objectives you might want to cover with your advisor, and essentially things to look at and to prepare for when you're approaching or at retirement. Esther, perhaps you can cover who this podcast is for.
Sure. So I think as advisors, one of the most common reasons that people seek out advice and come to us in the first place is because they are talking about their retirement planning and looking and deciding what to do next. So we see a huge amount of people at this life stage in their sort of maybe mid-50s to mid-60s, that kind of phase where they're stopping working or reducing working, and they're thinking about how to start taking money out of their savings and investments that they've worked towards all their life. So it's certainly, it's a change in mindset for a lot of people. So there's this big thing around you work, you save money for your future. It's very, very hard for a lot of people to make that switch from one to the other. So going from being the earner in the household, saving on a monthly basis, to actually flipping your mindset towards taking down from your savings and that being okay and that being sustainable can be really hard for people to achieve. So hopefully the idea about today is to give people a little bit more insight into how that all works and give people a bit of reassurance that if the right sort of techniques and strategies are followed, then they should be fine.
I think that's actually a really important point, just to sort of jump ahead, which is that mindset switch of allowing your total portfolio value to actually go down.
Yeah.
And that's actually okay in retirement. Not everyone feels that way, and I understand why, but actually that for many, not for all, but for many, that is part and parcel of being retired and spending what you've accumulated. So no, really good point. So perhaps we can start off with things to prepare for when approaching your retirement. I suppose number one really is to make sure you're working with an independent financial advisor so they can help guide you. There are lots of free tools often via your workplace pension. PensionWise is another good website you can refer back to, but really in an ideal circumstance you want to be seeking advice. It's a huge moment in your overall financial planning. And in terms of preparing, I mean, really, I always say the more the merrier. So I will ask, whatever pension statements you have at home, whether, whichever the most recent statement is that's come through the post or on email, having a good idea of not just your pensions, but all assets. So ideally values of your cash and your investments and anything else that you might own. And the other really important part is expenditure. So I feel like this is something that people don't necessarily tackle until sometimes that moment. And you first ask a client, well, how much do you spend each month? It's a bit of a scary question.
And most of the time the answer is, I'm not actually sure.
Not 100% sure.
A lot of the people we work with are in that sort of comfortable position by that point of not having to necessarily think so hard about what's coming in and what's going out. And certainly the way I tend to approach this with people is sort of advising them to take that time and going over the last 12 months and collating how much they spent on each thing. And then we work out sort of how that averages out over the year. And obviously that can take out any big expenditure that won't happen again, like paying for a child's wedding but by working out what you honestly spend and being honest with yourself, that's for me the key, because a lot of people think they're spending more or less than they actually are.
100%. And it's also, I find, although sometimes it will take a bit of time up and that can be really challenging, everyone's busy, but it's really time well spent, because often that is the key for us to be able to say, yes, you can retire now, because we're really confident that you can meet that expenditure need. And then the other point would be objectives. So some people will perhaps intend to live out their retirement very similarly to when they were working. But for most, that's not the case. There's plans such as downsizing, moving somewhere else in the UK or even abroad. There may be, part-time work they're looking to take on. There might be
travel plans,
traveling, some gifting. As I say, the fun budget. We want to probably make that a bit bigger. I've got a bit more time to enjoy yourself. So there's usually changes, but not just adding, it's also taking away. So don't underestimate the fact your mortgage might get paid off, or your child might have graduated and you're no longer helping with uni fees, or whatever that other minus figure might be, or travel costs. That's a real sort of misunderstood factor. I know people tend to claim for mileage and so on and so forth, but again, it's something that can be quite a big change each month if you're no longer needing to commute. So yeah, having a really good idea of that information to start off with is great. Given we're talking about approaching for retirement, let's start off with the main event, which is pensions. Esther, maybe cover a little bit about views on pension planning.
Sure. So pensions are by no means the only vehicle that we use, investment vehicle that we'd use for retirement planning, but they're definitely they're the big one. So pension is ultimately a tax efficient savings vehicle for someone to save into with the view to use that money at retirement. That is what they are for. That is what they've always been for. They have a little bit of a bad rep, I think, pensions. There's been various sort of scandals over the decades and things that have not helped with that, and I think the media have sort of slightly turned against them often. But actually, despite that, and despite the fact that a lot of people think they're very boring, unlike people like you and I who live and breathe a pension, but without that bad rep, pensions are very, very, very useful and tax efficient investment vehicles, ultimately, which is what they are. Effectively, the money grows in them and benefits from what's called gross roll-up, which means there is no taxation whilst the money is growing. And then at retirement, people can take 25% of it tax-free and the remainder is taxable. That's a very basic outline, but that is the sort of main points. I think one of the misconceptions probably around pensions is the flexibility of them. So they're often seen to be quite like a rigid thing, and they certainly used to be. So a lot of the older pension vehicles used to be all about you reach an age that you set when you're in your 20s and you take it out and you decide I'm going to retire at 60. How you are meant to know that, I'm not sure. And at that age, you are obliged to take them as an annuity, which is like a guaranteed income for life. That all changed when George Osborne made a load of changes in the Pension Freedoms Act. And now we have much more options. So we can, with the modern pension, we can be much, much more flexible. You can still take an annuity. And for some people, that is absolutely the right option. But I'd actually say that for those that come and take financial advice, probably well over 70%, if not more, would take the drawdown option, which is the drawing from it flexibly over time, as and when you need it, and that can be changed. And what that does is it maintains you access to the capital, which can be much better and more flexible for probably the vast majority of people that we work with. So that's a bit of an outline on kind of how pensions function and the options that there are. And there is a lot more complexity within that. But for a pension to work well, ultimately a pension is just like a house for your money to sit in. It's like a sort of tax efficient wrapper. What really makes them work well is the investments that underlie that.
Yeah.
And that can be very different during that accumulation of wealth stage compared to the decumulation or drawdown stage. So do you want to touch a bit on that?
Yeah, I think you've raised a really good point, which is sort of that abundance of choice now. So, okay, you may have had a pension that had a statement through the post once a year, but actually, you've got that field of various different sort of products open to you, and you can have a far more interactive pension, shall we say, like more interesting. So if I was to, again, sort of sticking to the brief of in retirement, I'm going to focus here on how we might consider decumulation as advisors. And part of that, if we're, remaining with a defined contribution pension that's invested, will be how the style of investment that you choose or the level of investment risk you choose within the pension wrapper. So if we take a self-invested personal pension, a SIP, which again, sort of a more modern option for clients, it would be quite common, I would say, for clients to come to us with various different pensions that they've accumulated in various group schemes over the years. And when you get towards that retirement date, it's quite common that you may consider consolidating those. So taking the example of sort of a modern day SIP with lots of different options and lots of different investment styles, one of the things your advisor will tend to do will be to talk about that draw on the pension. So i.e. what you need to take from it for your retirement. How much is it going to be per annum and when do you need to start taking it? And they'll consider that alongside your total pot value and any other incomes that you might have coming in. So for example, again, you might have state pensions kicking in later on or other types of rental or final salary income. And they'll calculate roughly what that draw on the pension is going to be over the next, say, 5 or 7 years. Usually, and again, usually, because every case is different, it will be good advice to de-risk some of that pension pot. So you've done really well to build up all that money. You've been putting in lump sums and monthly contributions. You've had it in some sort of equity-based fund, perhaps. Well, now that we're looking to take money from it, we might want to take some risk off the table. And how you do that will just vary on the person. But some of the things that us as advisors might consider will be things like lower risk funds. So you can have perhaps money market funds, which are cash-like investment funds that will provide you a yield similar to that of an interest rate at the bank. So in 2026 today, in June, that rate might be around 4%, let's say, but again, it will depend on the circumstances at the time. They might also consider funds that have other types of lower risk holdings, so mostly made up from corporate bonds and government bonds, US treasuries. And again, that's going to give you a return similar to that I've sort of mentioned, and usually a slightly less volatile holding than other equity-based investments. So that will be perhaps a consideration for the advisor to put some money into something like that. But it's not just funds that are available in modern day SIPPs. We also have things like cash ladders. So again, depending on the provider that you're with, you might be able to actually invest some of the money in the pension into effectively high street banks. So banks will have deals with various platform providers that allow them to put money into savings accounts. And again, let's take 4% as the rate. It's going to vary, but roughly that might be what you might get. So you can lock that in either into fixed term deposits or into notice day accounts. And again, it's going to give you some level of interest for a section of your money, but it's going to be pretty low risk and hopefully just about keep pace with inflation. Outside of that, there are lots of other options. So it might be that your advisor might consider things like structured products. That, again, without going into too much detail, that might be a type of investment that gives you perhaps a predetermined income or a predetermined growth rate per annum for the term in which you hold it. And it might be that your advisor does that directly with yourself, or it might be that they work with a discretionary fund manager, sort of another provider, in order to get you the sort of breakdown of structured products that might be advisable within your pension. For the other thing I'd probably say is this is all sort of potential options for someone to consider in terms of de-risking some of your pension fund. But remember, the exciting part here is not all of your pension needs to be de-risked, and that's a big change. So going back to Esther's description of pension freedoms in 2015, previous to that, a lot of the times you approached retirement, effectively your whole pot was de-risked because it was there to buy an annuity. Well, nowadays, that's not always the case. So actually, again, best advice tends to be that you might de-risk part of that pension, but there might be another section, or certainly a large part of that pension that remains in equity-based holdings because you're able to leave it invested because you might not spend it for another 10, 15, 20, 30 years. So again, given you've got the flexibility in the scheme or in the pension scheme, you're likely to have a bit of a variation in how you invest that pension. And I would also say that the options available to you are likely to be really quite far-reaching. It's not going to be just a pretty bog standard list of 10 funds. There's probably going to be, a real variety of options available to you if you are in a modern day pension. So that just gives a little bit of a flavour without going into too much detail. But as I say, every client will be different. I think another thing to probably talk about, which helps to summarise some of these choices, is sort of these buckets. So with clients, I tend to talk about the shorter term bucket. Maybe there's a medium term bucket and there's the longer term bucket. And really they're just time horizons of us trying to figure out roughly when do you think you're going to need this money? Yep. And therefore how much risk can we take in each bucket? Each advisor will do it slightly differently, but I think for, certainly with clients, I find that they tend to resonate with that description quite well. I'm sure you're probably the same.
Yeah, it does. And it helps people to understand about the fact that if you're retiring at 60, you could easily have 30 years plus of spending out of that pension. And what you don't want to do, therefore, the funds that you're not going to need for 30 years, why would you de-risk them now? And I think that really helps people to understand, okay, we're going to take 3 to 5 years, whatever it is, of your income, and we're going to de-risk that now so you know it's safe. So no matter what volatility the market throws at you, it's safe. And then the rest we take the relevant amount of risk on. I think it really helps a lot of people.
I think so. And I also think it makes it actually the process more engaging because there is such a variety in it. The other thing I would say is this is not just about pensions. So some of those investment options that we've just covered together, yes, they're available within a pension, but they're also available outside of a pension. And it will be, again, very common that within this retirement planning, we'll be talking about how to, alter other products, whether that be ISAs, general savings, investments, to fit alongside your pension and form part of your retirement plan.
Sure.
I know something that we've been doing a lot of at Integrity365 is gilt ladders. And this is purely really down to where the market is today. So sometimes this will be in favour, sometimes it won't. It will just really truly depend on what rates are available at the time. But for those clients that might have, perhaps there's a final bonus that gets paid out at the end of their career, or some other sort of a cash injection of money outside of their pension. If we're looking to take income from that, or capital lump sum payments from it, sort of in a short time horizon, it often, alongside that cash ladder option we discussed, it might be sensible to consider gilt ladders because there's a real tax efficiency that comes with those. So essentially, all those are it's debt with the government. It's lending the government lending the government money to use on fiscal spending. And in order to do that, they give you a return. They give you a sort of a coupon, an interest, and also some sort of capital uplift. And the reason we tend to quite like these products with our clients is because there is some tax efficiency there, where actually that capital uplift is tax-free. And for our higher and additional rate taxpayers, that can be really beneficial. So again, that can, for shorter term spending, that can be a really good option. But just to complicate matters further, we've also got inheritance tax considerations here. Do you want to talk us through about some of the trust options that sometimes feature?
Yes, so we won't go into lots of detail around this today because that's not the focus. But I think a lot of the people who come to us with pension planning need or retirement planning need also are starting to think about their inheritance tax liability. Now, pensions have recently, there's fairly recently been announced as coming inside the estate again. They used to be, and they were taken outside the estate about 10 years ago, and now they're coming back in again from April 2027. So that means if someone has really focused their savings on their pension over the years and has, let's say, large pension pot, 500,000 plus, that is going to be coming inside their estate for inheritance tax planning purposes. And that has sort of created a lot of noise around this in a bigger conversation. And so there's been a lot of talk around the other options. So it's not just pensions. Someone might have ISAs, they might have cash, they might have other investment bonds, for example, or gilts like you were talking about. And they do have other options around that as well. So there are trust-based investments, which, for example, mitigate the capital outside of your estate while still providing you with an income, or mitigate the growth on capital. There's quite a lot of options, and it's not for us to discuss here. But I think what's worth mentioning is that it's not just pensions, and though pensions are mentioned the most, we might use a whole combination of and blend of different approaches, some of which might be inheritance tax efficient.
Brilliant.
Okay, so we've covered quite a lot of ground already. So I think what would be really helpful is to kind of bring this to life a little bit and talk through a case study example. Now, these are not real people, but this is just a case study that I've put together just to exemplify a fairly typical type of situation that we might see. And then I'm going to ask you to answer some questions and solutions on it. So no pressure. So we've got a couple in their mid-60s called John and Susan, and they are married. Susan has £800,000 in pensions in total, but they're all scattered about in 6 different places.
Okay.
John has an NHS pension, which is already paying him £25,000 a year. Susan is still working, unlike John, but she's hoping to retire in a year if she can afford to, or she would be comfortable to work part-time. They've already done expenditure projection, and it's showing them as having a need of £100,000 net per annum to spend. So What's the first place you'd start with this?
So thank you for the case study. So yeah, I think what I would do here is I would meet with John and Susan, and I would ask them, first of all, as I said from sort of the start of this recording today, to gather all the documents of the current pensions they have and any other assets and sort of essentially financial records that they have. The other thing, when you said £100,000 of expenditure, my eyes drew to that point straight away, because again, is that just their expenditure now? Is that their projected expenditure in the future? What's it going to look like? So I would gather all the information on their current circumstances. I would ask them, I'd probably provide them with the handy expenditure template that I tend to use, and I'm sure you do the same, to say, right, based on that £100,000 projection, try and figure out here if any of the spending is going to stop or if you're going to add to it in any way, and just get them to, again, really look at that. So I'd ask them to rebudget, have a think about their objectives, and then I'd probably wait to hear what they had to say.
Sure. Okay, so let's say they go away, they do what we've already discussed about, they go through those bank statements with a fine-tooth comb, and when they've done that, they've actually realised their mortgage is going to end in a couple of years, they're currently helping their daughter with university costs, and they've currently got a car on finance. So actually, when you sort of look at that and you factor all that in, that reduces their spending need to 70,000 per annum. So it's a 30,000 less than they originally thought. So already a good outcome from conversation with yourself. So we've reduced that spending need to 70,000. What's the next step from there?
So I would first of all look at that and think, okay, now these numbers are starting to add up. The 100,000 sound a little bit punchy for retirement. 70 based on that debrief sounds realistic. And the reason why I say this is because in this meeting, I've checked with the clients and they've both confirmed to me that they're going to have their full state pensions, which in today's terms is probably about 12,500 per annum, with the triple lock if it stays. So that's a big chunk of their spending. Plus, you mentioned John had his £25,000 of income. So actually, a really large part of this projected expenditure is going to be met via either the NHS pension or the state pensions, and therefore Susan's defined contributions are just going to be needed to top up sort of the period of time before the state pensions kick in, but then of course any remaining balance once they've both started. So this is looking like a realistic picture, which is always a nice place to start. I would plug all that data into a cash flow, and I would just sort of test this out with them, make sure that we're on track and that these numbers are adding up.
Sure.
And I would factor in various scenarios there. So you mentioned the mortgage paying off. Do we need some tax-free cash out of the pension to just finish that off? Is there a sort of remaining balance, or actually is it naturally going to come to an end in the next year? I mean, judging by the information you provided, it looks like actually there'll be a little bit more left beyond the 1 year. So again, I'd probably test a few sort of scenarios as to whether we should pay that off in full or let it run to the end of the contract. Also, you mentioned the fact that the pensions were in various different places. I would have gathered all that information together. I would have looked at what available options there are. So the charges and the funds and the drawdown options. In my experience, ordinarily, workplace pensions will be nice and cheap. And hopefully they've offered you a good pension fund and it's been growing quite well. But on the back end, when you come to take money out, that's where they tend to fall down. Yeah. So those pensions are usually set up all around accumulation, for workforces, putting money in. They don't tend to be as well versed at sort of giving you various different pension options. So ordinarily, if you're looking to draw down, have flexible access drawdown, a lot of the time it might mean either moving away internally or sort of switching internally or moving away to another provider. So all in all, again, depending on what she's got there, I'm probably going to be consolidating the majority of it. Hopefully she's got some good old schemes in there, maybe some with safeguarded benefits or something sort of worth keeping hold of. By all means, leave that where it is. But if there's nothing particularly, special about the current scheme, then chances are we'll probably be consolidating it. And that's going to give us a nice sort of pot. I think you said it was £800,000. So with that, going back to the conversation we had earlier, I'll probably work out with Susan roughly how much of that we think we want to put into that lower risk bucket.
Sure.
And that's going to be, as I say, built around those timelines when the mortgage gets paid off, when the state pensions kick in. And then we'll effectively set the pension up to pay out a monthly income to meet that expenditure need, to sort of top up the expenditure need. And again, it will probably have some flex in there built in around various dates of when various sort of payments come out and money comes in. And again, this is all on the premise that I've assumed that they're not going to be taking a annuity. They may well do. Again, it depends on the client. But the reason I've assumed that for this case study for now is just the fact you've told me, actually, we're going to have an NHS pension with 25,000 of it secure, plus we're going to have the state pensions in secure income, which actually means you probably want a bit of flex in the rest of the plan if you've already got guaranteed income on sort of the other half of it.
And they also, you obviously mentioned that they're going to have that shortfall now, before the state pensions kick in, but not after. So if you annuitize the whole thing now, they're probably going to end up with surplus income in the future. Whereas if they don't and they have that capital, you know, we've mentioned on here that they've got a daughter, they might want to pass some of that on. Sure. Might be available for care costs.
Actually, it's a really good example you're given, because I've done this in a live case where what we did in that circumstance is we had decided that they were suitable for annuity, or certainly for some of it to be annuitized. And so the way we worked around that exact problem is we actually just annuitized up to the long-term expenditure need.
Yeah.
And for the so that's annuity income was for sort of a smaller amount. And for the shorter term, whilst you could have taken, say, a short-term fixed-term annuity, we just decided to actually put that into sort of a lower risk investment that could be used for drawdown. So there are lots of ways around it, but again, it just depends on the client. The other good thing about this projection would probably be, she's mentioned about wanting to know whether she can afford to retire or whether she needs part-time work. Again, now that we've done that expenditure work together, it looks as if she probably can retire. But again, my cash flow would provide her with assurance of that. If I felt that they needed a bit more of a buffer, then it might be that my recommendation was to do a little bit of part-time work, or to perhaps consider working for another year or two, or another solution might be to say, well, is there anything else in your expenditure forecast you feel you can go without? Although, you know, that doesn't tend to be the exciting part of the job. I tend to prefer to avoid that outcome if we can, but sometimes, you know, that's necessary.
Yeah. Well, certainly from those sort of basic figures and from this very high level sort of outline of a case study, it sounds positive for them, doesn't it? And it sounds like she can retire now, which is good. It's always a nice position for us to be in.
It's one of my favourite parts is being able to tell someone they can retire, and then they're going to meet the sort of the desires that they first came into the meeting with. So no, it's always a rewarding part of the job. So nice to end on a positive note. Our clients, John and Susan, can retire. Perhaps now we can end with some of the common concerns that we tend to hear. What would you say clients tend to sort of raise with you in meetings?
I think the big one is always around the sustainability of income. And that is where a financial planner can really help you, because like you said before, with cash flow modelling and with sensible investment strategy, there's no reason that income shouldn't be sustainable. And what is sustainable for one person will be different to another. So I have some clients who want to maximize an inheritance for their children. And therefore we want to work towards taking an income that sustains the level of capital that they have, or even grows it. And then we have other clients who go, well, I've worked all my life for this. I want to die with nothing. You know, and then we will work towards a plan that will mean they effectively die with nothing. And then there's everyone that sits somewhere in between. So it's very individual, but if you can get in touch with your financial planner and get some cash flow done, I think that gives people a lot of confidence. And if you link that into a really solid strategic investment strategy rather than just a random selection of funds, then there's no reason to sort of not be in that position.
So thank you for that. I think another thing I'm talking about a lot is the changes coming through in April 2027. Do you want to tell us a bit more about those?
Yeah, of course. Yes, we mentioned it briefly before, but effectively pensions are coming back inside the estate, which means that from April 2027, except in certain circumstances, your pension will form part of your estate for inheritance tax. Now, that is a big change for a lot of people. There are ways, however, to plan around it, and we've certainly had plenty of warning, which is really good. It puts us in a position of being able to plan with people who want to plan around that. And certainly not everyone wants to. Some people don't, mind about inheritance tax, and that's absolutely fine. But if you do, there are options, and we're not going to go into lots of detail around this now. But we actually did do a webinar recently. So if you're a client of Integrity365 and you're interested in that and haven't already seen it, you can let us know and we'll send you the link.
I think another area that tends to worry clients is care costs, which I can completely understand.
Yeah.
I had a case actually the other day, and they were considering that the cost for his wife was probably going to cost about £104,000 per annum, which I know sounds like a lot of money, but unfortunately they're not alone. No. So again, it would depend on where you are in the country and various other factors. But, it's a huge concern. And certainly from a financial advisor's perspective, when it comes to pension and retirement planning, it's awfully difficult to plan for that because you don't know if someone's going to need care, how long they'll need it for, how much it will cost. There's so many unknowns. So what I would say with that is that, when you come to talking about your expenditure needs, the advisor usually will talk about later life care and about how there might be an uptick or an increase in your spending at the latter stages of life. So it's quite typical that when someone first retires, they perhaps spend more money. There'll be maybe a sort of a time in their life where that starts to dip down, perhaps mobility and things change a bit and they spend a bit more time at home. And then again, at the latter stages of life, sometimes that cost can go up again. But everyone's journey is very different. So what I would suggest is with your advisor, perhaps doing some sort of contingency planning, talking about where money might come from should that need ever arise. You're never going to get it quite right because no one truly knows. But, don't let that put you off making, fun retirement decisions when you leave work. You've worked all your life to enjoy your money. A good retirement plan will have taken care of some of those considerations.
Great. So I think we've covered a lot of ground today. We've talked about how pensions work, options at retirement, different styles of investing. We've talked about cash flow modeling. We've talked a case study. There's quite a lot for people to digest there. But if there's anything in this podcast today that resonates with you, what I'd really suggest is that if you're an Integrity client already, reach out to your advisor. If you're not, we'd love to hear from you. Do reach out to us. We'd be very happy to have an initial chat with you. And as you're approaching that change in your life and that change in how you take your income, it's just a really, really good time to have a chat with someone and see whether you need to take professional advice. So thank you for joining us today. You can see more of our financial insights on our YouTube and Spotify. And otherwise, we look forward to speaking to you soon.